Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and watching the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. Before we get started, just be aware my process is running slow today. Something's going on with the internet. So if we have any problems, Dimitri will walk you through. I may be in and out, but let's welcome now Dimitri Pogomonic to the stage, who will be talking about IV rank and option contract. How you doing, D?
Good. Thanks, Will. Good morning, everyone. And yes, we're going to take a look at an option contract, picking an option contract. Each option has its own ID, and how can we rank that implied volatility? So let's first go and look at an example, and let's type in SPY up top. Go to SPY, and we end up on SPY's main page. What we want to do is go to the option chain, pick an option, and look at its ID. So on the left-hand side, we're going to click on options. We're going to click on option chain. This brings up the option chain for SPY. I'm going to click on this menu to minimize it and expand our screen. And let's go. You could see that in SPY, we have these different available expirations that have listed options. If we click on an expiration, let's say this one, it will bring up the option chain for that expiration. So you can see here it matches up. And for within the expiration, right, what the important thing is that each expiration is different because we have different amount of days to go before this option expires. And that could be important when you're looking at an option's implied volatility, because implied volatility, it's not, a straight across each expiration. Look, you could see here, these are the at the money IVs, and they change as you go out, in time. And that is typical because, traders could give a different implied volatility for later months than more short-term months, especially if you think that, well, I have more certainty, the next 2 days or 3 days than I do the next 200 days. Well, that implied volatility could reflect that. If there's more uncertainty, for example, today, then it could be inverted. So even between expirations, we see implied volatility change. So when we're looking at a rank, and we want to rank an option with 2 days to go, well, it makes sense then to find options historically with 2 days to go. So we could compare, today's options that have 2 days till expiration to historical options that have 2 days, right? Because why would we compare 2 days to a 200-day option? We want to kind of line them up so the data is similar. However, then within this 2 days, for example, we have all these different strikes, right? So we have, we have call options on this side, we have put options on this side. But you can see as you go in strikes, these are the implied volatilities of the bid, this implied volatility of the ask. So, the midpoint would be the implied volatility of this option. We'll say like mid-market we'll say this is the midpoint IV. But you can see that the IVs change, right? You can see it goes from 11.5, 11.3, 11.2, 10.6. So as the strikes change, the implied volatilities are also changing. And this could And this is a skew, right? We talked about a horizontal skew across time, but there's a vertical skew. And this makes sense for various reasons. Maybe traders are looking at the stock as the stock moves away, the volatility can change, the behavior can change. So if the stock is moving up, look, for example, in this situation, the traders are saying, well, if we move from this at the money higher, it will do it at a slower and slower pace. There's more certainty. If we look here, if the stock starts moving lower, that means that it could accelerate because of uncertainty. So the implied volatilities are changing. So if we look at a particular option, let's say we pick this one, well, we see that this is 0.6% above the current spot price, right? So for this strike, it's an out of the money strike, and it's a strike that's higher, right? An out of the money call higher than the current price of 679. So that becomes important, because if we are trying to compare an implied volatility of a particular option with 2 days to go, let's say it's 1% away, right? An option 2 days to go, the stock has to go up 1% for to reach the strike. Well, we don't want to compare that implied volatility to an option, let's say, that has 2 days to go and that is 4% below the strike, 4% out of the money, because then those implied vols are different, right? Those implied vols are going to be different. So we have to take the call that has 2 days to go, and let's say we do the 1%. What did I say? 1% out of the money. Okay, 1% above, and we have to say, okay, this is the current implied volatility for the 686 strike. Let's say 10.7. So if it's 10.7, we need to find historically options with a similar characteristics. 2 days till expiration, 1% away, and then compare those implied volatilities to this 10.7 to give it, so we could make a assessment. Are we currently on the high end, low end of the historical range, in the middle? Did we go above? So we need to find those options, line them up, and then create an IV rank. So if we created one number, right, just an initial number, an IV rank, how do we do that as a reference price, right? Look, okay, we've got 10.7, we've got all this historical data. So if we just needed one number to give us a quick idea, are we on the high end or low end? Well, we could line up all the historical data from high to low, right? So we'll just say, here's all the historical data. We have, implied volatility of 12, 11.9, 11.8. Line them all up, and then get a number that says what percent of that historical data is below 10.7. So then we have an idea. So if we're all the way on the high end, 10.7 is the highest, then 100% of the historical data will be below, meaning that the current IV is on the highest range of our historical data. If 10.7 is in the lowest, right? If, let's say all the historical data is above 10.7, well, our IV rank will be 0 because there's nothing below 10.7. Everything's above, right? So we could take that number and get an initial assessment. And that's what this is, IV percentile, saying 42% of the historical data for a similar option, the implied volatility is below this 10.7, meaning 58% of the historical data is above. So if we click on that, right, it's going to bring us back that data. And then we could quickly kind of see it in the chart. There's probably a lot of data in the SPY, so it's loading. So here it is. So Here's all this historical data, going back to 2017, could, come in. But what this is looking at is a 2-day, right? Past observations, calls, 2 days to expiration, 1% away from spot. These are the implied volatility observations. And this is saying is, well, currently we're at 10.7 on the bid and offer. So 42% of these observations are below. The average of all of them is 16.9. So the average could get skewed, right? That's a little bit different because, if you have these big outliers over here, right? Look at these big outliers. Well, that, as we know, an average will skew the data higher when you have these big outliers, right? So if you have 5, let's say you have 10.7, 10.7, 10.7, but then you have one observations that's 200, well, that 10.7 gets skewed higher by that observation. So now we have this average 16.9. Well, just to get a sense of the skew, is 16.9 skewed much higher, we could take a median. A median is saying if we took all these observations, lined them up, highs to lows, and then split them in half. Half of the observations are above this amount, half are below, right? That's the median, 14.6. So you could see that the data is skewed higher. The median is 14.6, but the average is 16.9 because you got the big outliers out here, right? So even if we take the median price, this tells us, hey, but there could be some spikes in there, right? Like the data is showing us that we could experience some outlier spikes. So lastly, you could say, all right, here's 10.7. I have my IV rank, I have my average, I have my median, but what is the high-low range, right? What is the lowest we've seen? What is the highest we've seen? And where are we compared to that? So you could see here the lowest was 4.3 IV. So it got pretty low. Maybe for the next 2 days, nobody was expecting anything to happen, and the implied volatility got really low, got crushed. The highest we've seen is 128.6. So you could see that the range, if we just took the high-low range all the way out to here, that's a big range. It doesn't probably happen often, but at least we have a sense of now, where's the implied volatility in this particular option? We got the IV rank, we got the average, we got the median, and we got the high-low. And now we could kind of assess it like, yes, this looks that we are closer to the lower range, right? We're in 42 percentile rank. So 58% were higher. The average was 16.9, we're below that. The median, half of them were above 14.6, half below, we're below that. And we could see even if we just took the high-low range, 10.7 is closer to this 4.3 than the 128. And this gives us a quick way to assess the implied volatility on a particular option in a particular expiration and a particular strike. So Will, I'm going to throw it back to you. I think I covered that piece.
Hey, D, can you hear me?
Yeah.
Rob asked a question. He's like, Will, please ask Dimitri if there is a way to see the final day of volatility on an option. This is for 0 day to expiration trading in SPY, etc.
Wait, say that again, Will. That you don't sound like you're faded.
Sorry about that. He's asking, is there a way to see the final day of volatility on an option?
So that's a good question. So let's say we have an option that expires today, right? Here's an option that expires today. Well, once you get to the end of the day or like expiration, The option doesn't have any more implied volatility, really. It's going to either expire worthless or it's in the money, right? But volatility, what is volatility? Volatility is a derived value using the option pricing model that says the following. If the option is priced this, and and all these, and you enter all in these inputs, days to expiration, interest, dividend, strike. If you enter all these inputs, and this is the price of the option, and you trade this option based on this Black-Scholes model, right, delta neutral, then this option is implying that the daily average volatility is this. That's the implied vol. So when you have one day to go, there's not really daily averages in here, right? It's just like, here's the option. It's either going to be in the money or out of the money. So you can't really, once you get into the today's expiration, it's the IV is not as, it's no more daily volatility, right? You're not taking in average daily volatility. It's harder to price once you get into the last day of trading, right? Because then you got to kind of like, you're tweaking the model kind of to say, well, what if we give it a half a day or a quarter of a day? But in essence, when we look at implied vols, it's looking at, on average, what's going to be the volatility, right? So if we have 3 days to go, you could have, volatility of 20, one day 11, whatever, but you average them out and you're like, on a daily basis, this is the implied volatility, averaged out for those amount of days. So at the end, at expiration, there is no real implied volatility because the option expired. There's no forward volatility anymore, right? Once the option expires at the end, there's no more forward volatility, right? You're not anticipating from that option more volatility because it's expired. There's no more to go. So you can't really even use it in that Black-Scholes model. Like, if you put 0 days to expiration in Black-Scholes model, it's not going to give you an implied vol. So it's a good question, but there's no like final implied volatility to an option in that sense, because an option premium is, once you're like, once you have like, expired, either it's worthless or in the money, or at parity, that's it. Doesn't Black-Scholes model can't tell you, well, based on this, the daily average implied vol is this.
All right, D. Thanks for answering that question. You have a great day, my friend. We will see you tomorrow, 9 a.m.
Right. Thanks, everyone, for joining. Stay safe. Have a great trading day.
All right, everyone. Thanks to Dimitri for joining us for another webinar series. For those who are joining for the first time, thanks for coming by and checking out the Market Chameleon webinar series. Remember to thumbs up, like us, follow us on all the platforms. Hopefully, we'll see you tomorrow at 9 a.m. Everyone have a safe trading day and a final thumbs up. Have a great day, everyone. Bye-bye.